What if I told you that you could get the same rate of return as major banks? You can make 5, 10, or 15% on your money just like they do. And no, it's not through some multi-level marketing scheme or something sketchy like that. It's by doing what has been done for thousands of years, lending money. Over the last couple of years, there's been a rise in peer-to-peer lending platforms that allow anyone to loan out money and collect interest payments on it. So in this video, I'm going to show you why people are attracted to it, the risks of peer-to-peer lending, the best sites to use, how to maximize your returns, and finally, my own thoughts on peer-to-peer lending. So if that sounds interesting to you and you like learning about business, investing, and personal finance, consider subscribing as I post one long-form video like this a week. But if you'd rather wait till the end of the video to see if I deserve a subscribe, that's totally okay too. No pressure. I just hope this video can help you achieve your financial goals. Okay, now let's jump into why so many people choose to utilize peer-to-peer lending in their investing strategies. Benefits of peer-to-peer lending. According to Forbes, the S&P 500 has averaged 7.58% or 10.51% with dividends reinvested since 1971. That's a really solid return, and like I've said in past videos, just buying into the market and holding is a great way to build wealth. So why do we need to look elsewhere to invest then? Well, the main downside of the stock market is volatility. Yes, over the long run, it averages out to be about 8%, but there are some years when we see major drops in the market. There have been times like after the dot-com bubble burst, where it took the market 7 years to reach its pre-bubble price. If you're younger and you don't plan on needing your invested capital for 30 years, this isn't that big of a deal. But A, eventually those 30 years till retirement will turn into 10 or 5, and you'll still want to get higher returns, but not want the volatility. And B, many people like to invest for things a little bit closer in the future, like a house, car, vacation, or education. And so there's definitely a place in investing for a non-stock asset. For the record, I'm not saying take all your stocks and convert them into loans. I'm just saying there are many benefits that make it so that you might want to consider a portion of your investment portfolio to lending, like maybe 5 or 10%. The first major benefit of peer-to-peer lending is that there isn't a high barrier to entry. For many of the sites, you don't even need to be an accredited investor, and there's not a huge cash investment required. For example, Prosper, a major peer-to-peer platform, only requires a minimum investment of $25, so pretty much any investor can get involved. Also, just a heads up, I'm going to use Prosper as an example a lot just because they are the company that I have the most experience with. Anyway, this minimum investment is awesome when compared to other alternative investments like real estate that would require tens of thousands of dollars just for the down payment. The second major benefit is that you are able to diversify and mitigate risk. You are not only able to select risk profiles for people you are willing to lend to, but your money doesn't all go into the same loan. Again, I'll use Prosper as an example. They let you choose from AA to E and high-risk profiles when you're allocating your money to loan out. Obviously, the high-risk loans will pay out more than the lower-risk ones, but the huge advantage is that not all your money goes to the same borrower. Let's say, for example, that you want to loan out $1,000 to a D-level borrower. Rather than giving all of your $1,000 to a single borrower, peer-to-peer lending platforms mitigate risk by splitting your money into $25, $50, or $100 chunks and spreading them across a bunch of different borrowers. This way, if one borrower defaults, you won't be screwed. The third reason why people choose to lend is that the returns can be really high. Right now, if you put your money into a savings account, which granted has lower risk than peer-to-peer lending, you will get about 3% back on your money. And 3% is way better than the rates were a year ago. The interest rates for savings accounts between 2014 and 2022 were practically zero. But now, because the Fed is raising rates, we are starting to see higher savings interest rates, but even when compared to these higher interest rates, peer-to-peer lending rates are still very attractive. For example, for an A-class loan that has less than a 2% default rate, you'll get 4% interest. A B-class loan, which has a low default rate of 4%, gives you 6% interest. And if you want to make some really high returns, you can go after the E or D-class loans that make 12 or 15% interest. For many investors, putting 10% or 20% of their portfolio in a high-yield lending platform like this can be a great way to hedge and continue to make solid returns even when the stock market is struggling. However, not everything about peer-to-peer lending is good. The main risk everyone thinks of when talking about lending is the risk of default, and that risk is real. Some people borrow money and they never end up paying it back. This is why you get paid a higher interest rate to lend to people who have a higher risk of default. Higher risk brings higher reward. You can reduce this risk by looking at each borrower's prospectus, but if you prefer to auto-invest and not think about it, Peer-to-peer platforms' diversification aspect helps reduce the effect one individual's default has on you, plus these sites have people to go after the defaulters. This means less work for you, and although some of the money you might never see again, the fact that they have people trying to reduce the effect of default is nice to know. Another risk of using a peer-to-peer lending platform is that the platform itself could go bust. Lots of fintech companies fail, and you wouldn't want to get your money locked up in one like the users of Celsius or FTX did. I'm just saying, FTX looks good, and it wasn't. You should definitely do your own research on whatever platform you decide to use, but if it were me, I would stick to one of the bigger, older names in the space. These companies are less likely to fall apart. Prosper, for example, is able to weather the 2008 financial crisis, and is thus a much more stable fintech firm than some company like BlockFi, which has only been around since 2017. The last risk of peer-to-peer lending is the opportunity cost aspect. Depending on when you watch this, market conditions could be different, but in November of 2022, you can buy a US interest bond that's paying 6.89% interest. These high rates are due to the inflationary environment we are in. Even though these bond rates are variable and you can only buy $15,000 a year, they are really attractive because they have no risk by being backed by the state. Now, one could argue that right now is the best time to be dollar cost averaging into the market, as since the market is down, all the stocks are at a discounted price, and that discount will become a gain when the market recovers in the future. These risks are all things to consider when deciding how to invest your own money, and I'll let you know my thoughts about the risks and rewards and how they balance out after we talk about which sites you can use and how to maximize your returns. But while we do that, let me know what you think of peer-to-peer lending down in the comments. Are you going to use it in your investing strategy or no? Now let's talk about what site you can use. What site should I use? Obviously, you can tell by the fact that I gave lots of examples from them that I prefer Prosper. They have a great app and user experience, offer flexibility, and have been around for a long time. For the record, I'm not sponsored by them. This channel is far too small to be sponsored, but if you think this video is a good video and you'd like to see more like it, be sure to subscribe. It really helps me out. Okay, back to the different apps to use. There are several apps that might work better for you than Prosper. If you are a crypto king or queen, you could loan out your crypto through BlockFi. They offer pretty high returns between 4.5% and 10%, but please be careful with crypto. It's much riskier than traditional peer-to-peer lending, and the crypto space can collapse at a moment's notice. Just look at Sam Bankman-Fried, who went from being worth $16 billion to being worth $1 billion overnight. Hey guys, so I am editing the video that you're watching right now, and it turns out that 2 days ago, BlockFi just declared for bankruptcy because of all the crap that's been happening with FTX. So this is just a reminder to be careful with your investments, make sure you research companies closely, and just be really, really careful. So back to the video. There's also Upstart, which rather than relying on FICO credit scores to determine risk, uses artificial intelligence to predict the likelihood of default. This proprietary technology has been very effective, and Upstart has similar rates to Prosper. So if I was going to try a different peer-to-peer lending platform, this is the one I would try. Now, how to maximize returns. Here are some tips to maximize your returns when doing peer-to-peer lending. First, use smaller, less-known platforms. They tend to offer higher rates of return but are also riskier. 2, do peer-to-peer lending in other currencies. 3, buy others' loans at a discounted price to increase your own rate of return. But more than any of these previous strategies, which honestly each deserve a video of their own explaining how to do them, I would just diversify a ton and automate it. And make sure you have a strong emergency fund on the side. The number one thing that will hurt your ability to make money through peer-to-peer lending is people defaulting. So the more you can diversify and spread out your risk, the less likely you are to have this issue. Also, these websites and the algorithms running them have a lot more experience than you or I do. So I would just say click that automated investing button and let it do its thing. But remember, you still need to have a strong emergency fund. Peer-to-peer lending may have a much shorter time horizon of investment than the stock market does, but that does not mean that you should not have an emergency fund ready on the sideline. It's really important to have 6 months of your expenses covered, so if crap hits the fan, you don't have to sell off your stocks or your loans at a discount. So, are peer-to-peer loans worth it? Honestly, it depends on your risk tolerance, the market, your view of the future, and your own financial situation. But I definitely don't think they are the money pit that some people make them out to be. I do feel like their use case is limited though. I feel like the biggest use case for becoming a lender in this manner is if you have a purchase or investment that you're saving up for that's in the shorter term future and you can't risk a major decline in the stock market. In that case, I feel like it's better to get 7% back on your money for the next 3 to 5 years as you save up for that purchase through lending than putting it in the stock market, which is much more volatile. But even with deciding to put 10% of my investments into peer-to-peer lending, I would still be dollar cost averaging the other 90% into a broad spectrum ETF or index fund. For long-term investing, nothing is going to beat an S&P 500 index fund or a broad spectrum ETF. But what do you guys think? Is the risk worth the reward in your eyes? Let me know what you think in the comments down below. I hope you found this video interesting and informative. If you did, give this video a like so more people will see it. And if you want more cool videos about investing, business, personal finance, and entrepreneurship, be sure to subscribe. Thanks again for watching. I really appreciate it, and I'll see you guys next time.